Hello and welcome to this screencast in which we will discuss about one of the most popular finance model, that is capital asset pricing model. So what is capital asset pricing model and why it carries so much weightage in finance world? The capital asset pricing model, in short CAPM, was developed by William F. Sharpe. This model predicts the relationship between risks and expected rate of return on risky securities. It explains how individual securities are valued, and it can be used for estimating cost of equity. Actually, what it shows how the individual securities are valued, because for every investment, what the investors look at, he look at the risk and the return. He asks generally three questions. What are those questions? How much risk a particular security carries, which investment is more riskier, and how much extra return is required to compensate the additional risk. Because every investor wants to get maximum return from its investment. So if he will invest in a riskier security, then definitely he will expect some higher return. So how the security is priced on the basis of its risk and return mechanism in the stock market, that is explained via our capital asset pricing model. The capital asset pricing model is based upon some assumptions. The first one is all the investors have some same expectations about expected return and risk of securities. It leads to explain that all the investors think about same return and risk, that every security has the same risk and return for every investor. All investors can lend and borrow at risk free rate of interest. Investors make their investment decision based upon single horizon. It means all the investors invest in a particular stock for same time period, like for 1 year, 2 year, 3 year. The capital markets are perfect. So what do you mean by perfect capital markets? The perfect capital market means all the securities, the information about all the securities is freely available. The another one is there is no transaction cost, no taxes, and all the investors have the same expectations. Then investors are risk averse. They prefer higher expected return for a given level of risk. There is a one thumb rule that higher is the risk, higher is the return. And the CAPM model assumes that all the investors are risk averse, they don't want to take high risk, so they will prefer to get the maximum expected return at a minimum risk level. The capital market is not dominated by any individual investor. It leads to say that no single individual has a power to influence the trend of a capital market. So, how we will mathematically explain the capital asset pricing model? So, the mathematical formula is expected RE is equal to RF plus beta ERM minus RF. So, what these letters indicates? ERE, it is the expected rate of return that investors think that they must have to get if they will invest in a particular stock. RF, it is the risk-free rate of return, the return that we are expected to get from a government bonds, that is a fixed return. RM is expected market return. Then beta, it is a systematic risk, or we can say it is a levered beta. Then RM minus RF, what this difference indicates? It is a market risk premium, means it is a premium extra return that investors require for bearing the risk of the stock. It means if I am investing in a particular stock, then how much extra return that I will expect if I will not investing in that stock and I will invest in a government bonds. So the difference in the risk-free rate of return and the expected market return is the risk premium. This is the graphical representation of a CAPM model. So what it shows? The x-axis, it represents the systematic risk that is represented by beta. The vertical axis, y-axis, it shows the movement of expected rate of return. It also carries risk-free rate of return and the expected market return. Then there is one line, that is the security market line. It is also known as the slope. So what is security market line? The security market line represents the graphical form of capital asset pricing model. It represents the relationship between the systematic risk or non-diversifiable risk and expected return from stock market. What we assume that the investor expected return lies upon the security market line. It is a combination of all the return that the investors think they will get from the investment stocks. This shows security market line matrix. What it indicates? If the stock lies below the security market line, it means the stock is overvalued. What does it mean? It means the investor's expectation that lies on the security market line, but the actual return that we will get from the stock that is below the stock market line means the expected is higher, what actual is lower. It means the stock is overpriced. If the security lies above the stock market security market line, it shows that the stock is underpriced. Means our expectation that lies on the security market line, but the actual performance it lies above the security market line. Means the stock outperform our expectations. It gives higher return than our expectations. So we will say the stock is underpriced or undervalued stock. That is one of the most prevalent application of security market line. It tells which security is underpriced and which security is overpriced. Another is capital market line. The capital market line indicates the relationship between expected return of portfolio and standard deviation. So what is the difference between CML and SML? That is security market line and capital market line. The main difference is that in security market line the risk is measured by beta, and in capital market line the risk is measured by standard deviation. Another one is the security market line indicates the systematic risk, that is beta, and capital market line indicates the total risk. The another big difference that we can discuss here, that the security market line gives the risk for a particular stock, for individual stock, but capital market line indicates the risk for a total portfolio, for a group of stocks. There is another component that is very much important from a risk point of view, that is alpha. It indicates the degree to which the return from stock has performed as compared to benchmark index. So if alpha is equal to 1, what it indicates? It indicates the stock outperformed its benchmark index by 1%. Means the return from stock is 1% higher as compared to the return from a benchmark index. If alpha is -1, it means the stock is underperformed than its benchmark index. Means the return that we are getting from a stock is 1% lower as compared to the benchmark index. If alpha is 0, it means the return from stock and the return from benchmark index is same. This is alpha matrix. This matrix indicates the investment strategies on the basis of the alpha. If alpha is positive, it means the security is undervalued, and if the security is undervalued, then the investors must buy that stock because in future it is expected that the price of the stock will increase. If the value of alpha is negative, it means the stock is overvalued, and what we expect and what is assumed that the price of overvalued stock will fall in future, so we should immediately sell the security in the market. The another component, or we can say that is backbone of CAPM model, is a beta, or we also call it as a levered beta. It is also known as systematic risk. So there are two type of risk in finance. One is systematic and unsystematic risk. So what is systematic and what is unsystematic risk? The systematic risk is unavoidable risk that we cannot diversify that risk. All the companies of economy have to bear that risk. What is unsystematic risk? This is the risk that we can avoid. We can avoid the risk by diversifying our portfolio, by withdrawing the investment from one stock and investment in another stock. So what beta indicates? It indicates the sensitivity of stock to the market movements, how a particular stock moves as compared to the market index. It also represents the relationship between rate of return from the security and the market index. How the return of security and the market index varies with respect to each other. We call it as a levered beta because we calculate beta for those companies which has a debt portion in their capital structure. The companies that don't have a debt portion in their capital structure are known as unlevered companies. How we will calculate the levered beta or beta? It is the ratio of return from stock and return from market index. So what this shows? It shows how the stock moves in response to a movement in the general market. Means if the market goes upward by 10%, then how much percentage movement that particular stock indicates, whether it moves to 10%, whether it moves to 12%, or whether it moves to 6%. So it indicates the movement, the comparative movement of stock with respect to the general market. This is another very important matrix that we call it as a beta matrix. If the beta of a stock is lesser than 1, it means the stock is defensive, means there is less risk as compared to the overall market, and we will get the less return. If beta is equal to 1, it means stocks are normal, the risk level in the stock and the risk level in the market index are same. If beta is greater than 1, what it indicates? It indicates the stocks are aggressive. The stocks are more volatile and riskier as compared to overall market, and there is probability that we will get higher return as compared to the market index. So what beta matrix tells? It tells whether the security is more aggressive, it is less aggressive, or it the level of risk is same as compared to the market index. How we will calculate the beta? The formula of calculating beta is the ratio of covariance between stock and the market index by the variance of the market. The formula for covariance, we can say it is a correlation between the stock and the market, standard deviation of stock and multiply by the standard deviation of market. And variance, as we have already studied in quantitative techniques, it is the square of the standard deviation of the market. So if we put value in this particular formula, then what we will get at the end? We get beta is a ratio of correlation coefficient between stock and the market multiply by the standard deviation of the stock divide by the standard deviation of the market. So what this formula indicates, what we assume after scanning this particular formula, this formula indicates that the stock with high standard deviation, if the standard deviation of particular stock is higher, it means that particular stock will higher value of beta, means the stock has a high systematic risk or more risk. If the stock is high correlation with the market, it means as the market moves up, the stock also similarly moves up. If the market become bearish, the stock also goes down. If there is a high correlation, then again the company has high beta and the high risk. Now, how the beta indicates the nature of the business? If the particular company related to a cyclic industry that is a highly correlated with economy, then beta will be high. If the company deals in with discretionary product, some differentiate like Apple, that has differentiate it from its the overall market, then again beta will be high. If the company relates to defensive industry, recession from industry, means the correlation with the economy is less, then we can say that the beta is low. Now how we'll solve the numerical problems? Calculate the value of beta when the required rate of return is 12.6%, the risk-free rate of return is 4% and market return is 15%. How you will calculate the beta and what beta indicates about the security? We will apply the basic formula, then we will calculate beta. The ultimate value of beta is 0.78. So as we have already studied, if the value of beta is lesser than 1, what it indicates? It indicates the stock is defensive, means it carries less risk as compared to the market index, and it is expected that our return will also be less. The second problem is the standard deviation of return of security A is 20 and market portfolio is 7. The correlation coefficient between market and security is 0.5, calculate beta. Here we will apply the second formula that we have discussed and we will calculate beta. So after calculation, beta is 1.28. So if the beta is higher than 1, it means the market is aggressive and it carries higher risk. Stock is aggressive and it carries higher risk as compared to the market. So now come to what are the limitations of CAPM model. The first or the major disadvantage of CAPM is it is based upon some unrealistic assumptions that in reality those assumptions are not true. The capital markets are not perfect. What we assume in CAPM model that capital markets are perfect, but actual the capital markets are not perfect because all the information is not freely available and equally correct information is not available to investors. It is very difficult to find risk-free securities. The lending and borrowing rates never equal. In actual, these rates, there is some difference between the lending rate and borrowing rate. Another is investors may not hold always highly diversified portfolio. It means that the investors are not risk averse all the time. There are some investors that likely to carry higher risk. What is assumption in CAPM that all the investors are risk averse, what in reality it does not hold good. Beta does not remain stable over time. We can't say that beta remains stable because with the change in economy, the beta of particular industry company will always change. Investors with single period horizon does not hold always true. Means all the investors do not invest in one stock for the same time period. Some investors may invest for 1 year, some may invest for 5 years. So the time period horizon does not remain same. In the end, we have discussed some MCQs. So if a security has high value of beta, what it means? It means it has a High non-diversifiable risk means high systematic risk. There are 9 MCQs. I think these are very important from the understanding of the concept as well as from your exam point of view. I will definitely recommend the students to go through these 9 MCQs, because by going through these 9 MCQs you will understanding the concept more. In the end, I gave some answers of these MCQs. Thanks all for giving your time. Thanks a lot.